Today we are going to analyze how transactions affect accounts. This is section 2-2 and it's on pages 32 through 36 in your textbook. So our first transaction we're going to be talking about is when we receive cash from an owner as an investment. Now, each transaction will change the balances of at least two accounts. There will be times when we get further along there will be more than two, but for right now we will just have two accounts. Now, each account, you need to write the correct title for each one. For example, cash, accounts receivable, whatever. And the list of all the accounts can be found on their chart of accounts. Each business has a chart of accounts, and there is one at the beginning before Chapter 1 for technical consulting. So when accounts are analyzed, debits and credits must equal for each transaction. In addition, after a transaction is recorded, total debits and credits must also equal. So when we receive cash from an owner as an investment, we first must figure out which accounts are affected. Just looking here, you can see received cash, so we know cash, and from an owner as an investment. That's going to mean our capital account. So on our T accounts, we're going to write cash, and then we're also going to write Kim-Park Capital. How is each account classified? So what we're talking about there is assets, liabilities, or owner's equity. Cash is an asset, Kim-Park Capital is our owner's equity. And our third one, how is each classification change? So if we received cash, that means our cash is increasing. So it's going to be a debit, which I'm skipping ahead to number 4. And our owner's equity is also increasing, and they increase with a credit, so it's going to be a credit of $5,000. Now, make sure when you are done, your debits and your credits equal, and they do. Always make sure they do. Double check that. Our next one is when we paid cash for supplies, $275. Now, a mistake that people make is when they assume that every transaction must affect accounts on both sides of the accounting equation. That's just not true. You can have two assets that will be affected, such as this one, which is supplies and cash. So when changes are made only to one side of the accounting equation, the equation must still be in balance. For example, one is going to have to be a debit and one's going to have to be a credit. So if you go through our questions, which accounts are affected? Paid cash for supplies, we know that's going to be supplies and cash. Now, if you look at that, you may want to put cash first, but we typically want to put the debit first and then the credit second. So you might as well get in the practice of doing so now. So our supplies is written first and then cash. How is each account classified? Like we said, they are both assets. How is each classification change? Well, since we bought supplies, supplies is increasing, and since we paid cash, cash is decreasing. So how is each going to be entered in their accounts? Supplies is going to be a debit of $275, and cash is going to be a credit of $275 as well. August 4th, paid cash for insurance. This is the same example as earlier where two accounts could both be assets. So which accounts are affected? Since we paid cash for insurance, it's going to be cash, and then our other account, which is prepaid insurance. Now make sure you write prepaid insurance, not just insurance, because the correct account title is prepaid insurance. Both of these are assets. How is each classification change? Well, we're increasing the amount of prepaid insurance we have, so that is a debit. And our cash, since we are paying cash, it's going to be a credit, so we'll put them in there as our debits and our credits. If we were to buy supplies on account, so on August 7th, bought supplies on account from Supply Depot at $500, our two accounts are going to be supplies and then accounts payable dash Supply Depot. Notice you can abbreviate accounts payable, ACCTS period, PAY period. Don't abbreviate it any more than that. That is the correct acceptable abbreviation. So those are the two accounts that are affected. Supplies are assets. Accounts payable, that is a liability. How is each classification change? If we bought supplies, they're going to increase, which means it's going to be a debit. And the amount we owe Supply Depot is going to increase, so they're going to receive a credit of $500. Our last one, if we're going to charge something to a company, we should pay them eventually, hopefully on time. On August 11th, we paid cash on account to Supply Depot, $300. So paid cash on account, we're going to have cash and we're going to have accounts payable. So notice this time though we're not putting, on the example that they have here, they have their T account with the accounting equation. When you do your examples, you won't have the huge T for your accounting equation, so it would be acceptable to put the debit first there as well too. So cash and accounts payable Supply Depot. Cash is an asset, accounts payable is a liability. We are decreasing our cash because we are paying cash, so cash is going to be a credit. And then we are also decreasing the amount we owe Supply Depot, so it's going to be a debit of $300. Work together for section 2-2 is on page 37. Our instructions are to create 2 T accounts for each transaction. On each T account, write the account title of one of the accounts affected by the transaction. And we'll try to get in the habit of putting the debits on the left side first. If they're not, that is okay for now. So our first one on April 1st, received cash from an owner as an investment, $5,000. So received cash, anytime you see that, you know it's going to be cash. From an owner as an investment, that's going to be our capital account. And if you look a little bit above the transactions, you will see our capital accounts. You will also see some other accounts we haven't used yet. We will use them in our next section. So 2 accounts. If we were to go ahead and pay in our transaction, we received cash from owner. So we know cash is going to be increased. And since cash is a debit, it's going to be increasing with a debit. So debit on the left side here. And our capital account is also increasing. Our capital account is owner's equity. Owner's equity is increased with a credit as well too. So we will be putting in our credit for our capital account. Now, if you know one of these, if you know cash is going to be a debit, your debits and credits must equal, so the other account must be a credit. However, don't rely too heavily on that, just so you understand how each transaction, how each account is affected. Our next transaction is on April 2nd. We paid cash for supplies, $50. So our 2 accounts that are affected here are going to be cash and supplies. Now both cash and supplies are assets, so they are increased with a debit and decreased with a credit. Since we paid cash, cash is going to be decreasing, so it needs to be $50 on the credit side. And since supplies is increasing, it's going to be $50 on the debit side. On August 5th, we paid cash for insurance, $75. So our 2 accounts that are affected are prepaid insurance and cash. Both of these are once again assets, which means they are increased with a debit and then they are decreased with a credit. So if we paid cash, we know that cash is going to be a credit of $75. And since our prepaid insurance is increasing, it's going to be a debit of $75. Notice once again how our debits and our credits are equal. On August 6th, we bought supplies on account from Bales Supplies, $100. Our 2 accounts that are going to be affected are going to be supplies and then accounts payable, Bales Supply. Notice how I have abbreviated accounts payable. That is the correct way to write it. Now, supplies is an asset and accounts payable is a liability. So we bought supplies on account. Our supplies are going to be increasing, so it's going to be a $100 debit. Now, accounts payable that we owe them is also increasing, so that's going to be a $100 credit for them since that is a liability. Once again, our debits and credits still equal. Our last transaction on our work together is April 9th, paid cash on account to Bales Supplies, $50. So our 2 accounts are going to be accounts payable, Bales Supply, and then cash. Accounts payable, that is a liability and cash is an asset. So since we are paying cash, we know that cash is going to be a credit. So I'll go ahead and drag my $50 over to credit. And then accounts payable, that is going to be a debit over here. Since it's normally increased with a credit, it's going to be decreasing now with a debit since the amount we owe them is decreasing. Make sure after each T account, each transaction, that your debits and credits equal. You can look in the back of the book, or excuse me, back in this section for more help if you need it. Your homework, like always, is going to be the application problems. It is application problem 2-2 on page 46 and 47, and you will once again be drawing T accounts. Please turn it in when you are done, and I will see you tomorrow.